So the results came out yesterday. It was a little bit of a disappointment. Net profit and EBITDA ended up being where I thought they were going to be in the first half, but the guidance for the full year is a bit weaker. So production guidance was dropped by about 500,000 BOEs. EBITDA guidance was maintained, however, which is interesting given the falling oil price environment. But the other big surprise was the capex. So capex has jumped by between 75 to 100 million, which is about a 10% increase. So that is material. And of that increase, about half is justifiable as new scope. So there's a few. There's an expanded exploration and appraisal program in the South Australian Otway tenure, as well as a offshore exploration well in New Zealand. So Beach bought into that. You might have remember that announcement if you're following it back in December. So that surprised by landing in this financial year instead of in FY21. The other half of the increase, though, is probably a little bit debatable. So Beach aren't able to point at this stage to what that capex is going to buy in terms of extra production. So that is increased fluids handling capability in the Western Flank oil, so that's Cooper Basin, as well as some maintenance works at Port Bonython, which is the Santos-operated oil export terminal in South Australia. So the increased fluids handling, it's not clear to me at this stage whether or not they will actually deliver the production for growth that they were previously pointing to, or whether that's in addition to. Beach weren't really forthcoming yet as to what the increased production, or if there are further increases to production, what that might be in future years. So I've kind of taken the conservative view and just assumed that that is just additional capex, which lowers the Rocky forecast for the year. Port Bonython's worth mentioning. I think that will unfortunately be will point to some ongoing spend. So Santos, now that there are increased fluids going down to that plant, have identified more work that they need to do to keep that plant running. So that is likely to be an ongoing feature, but it's not necessarily super material given the fact that Beach is pointing to or estimates IRRs from its Cooper Basin investments of over 100%. So Beach is still very confident, but it probably does weaken the returns somewhat. We have flowed through lower oil price assumptions. So in discussion with Adrian, we've lowered our near-term oil forecast. We are maintaining that long-term forecast at US $70 a barrel, however. So that does impact FY 2021 earnings, but we suspect in the long term that will rise once the coronavirus impact clears. So my advice would be to not necessarily jump in and buy the dip yet. It has been a stock that does get pretty excitable. The price can rally, and it has fallen quite a bit recently. It's over 10% in the last month. However, I'm still a hold on the stock. I think to get really excited about it, I'd have to be more enthusiastic about the economic prospects of the WA tenure, and I think that's where I probably diverge a little bit from the market. So I suspect I've got a higher capex assumption for the Waitsia Stage 2 expansion. So I've potentially got more scope in there than Beach would necessarily carry, but I need that scope, to be honest, to get the kind of production forecast that Beach were previously pointing to. So unless they get a higher price than the current domestic price over in WA through some kind of an LNG netback, I'm not too excited by the current price as it stands, and I'd be waiting for better buying opportunities. However, if you are much more bullish than I am on WA gas, then it could be a good buying opportunity now.